got that. We'll just come back to you. And in fact, I want to ask you about many more sectors, but due to paucity of time, I just want to squeeze in one more important trigger for the day, which is Reliance Industries earnings that comes out in the evening. Now, this time around, the oil to chemicals business is something that has grown sequentially. So that's the good piece. On the consumer side, there's a bit of a slowdown that we're expecting in the Reliance Jio numbers because there's been a lack of tariff hikes and that has slowed down the growth in that vertical. But Prabal Sen, who's the energy analyst at ICICI Securities, joins us now to talk about that. On a consolidated basis, we're expecting about an 8.5% revenue growth sequentially, a 5.5% EBITDA growth for the company and a 12% profit growth. Prabal, good morning. You tell us, in the oil to chemical space, GRMs have gone up if you compare them to, $6.3 a barrel last quarter. This time, I think around $8 plus is what we're looking at, Singapore GRMs. Your thoughts on how the numbers could look and your view on the stock as well?
Yeah, so we do expect a fairly robust set of numbers and almost...
Sorry, can you say that again?
Am I audible?
Yes, you're audible now. Oops.
Yeah, so I was saying that, the quarter is expected to be fairly robust. I think there's a very clear momentum in the PC segment, almost entirely led by the strength in refining, even though petchem is still about flattish from what we understand. But yes, in refining margins, there's a very clear delta of $3 to $4 on a sequential basis, which is what drives a 7 to 8% Q improvement in the segment EBITDA, and that is what is driving it. As again mentioned earlier, Jio numbers do look a little bit muted, maybe a low single-digit growth in EBITDA, almost entirely led by the net subscriber growth, while ARPU remains broadly flat at around 179 to 180 levels. So to that extent, I think the momentum in OTC will be a key to watch out for in the next couple of quarters as well. We have seen, however, in 1Q now, because of the sudden spike in crude prices led by the production cut of OPEC, that product prices have struggled to catch up. So there's been a sudden dip in GRMs post the Q4, passing. So I think to that extent, 1Q can once again see a little bit of a weakness on that front. But I think if we look at the prospects for OTC segment, the demand supply does look to be getting tighter for the next year, particularly if the Chinese demand resurgence comes sooner rather than later. So to that extent, I would still expect a recovery on the margins front for OTC. And Jio, of course, as and when the tariff hikes, whenever they do come through, that would be the next driver for the earnings for the telecom segment as well. Yeah.
Okay, got that. Just one follow-up before I ask you your view on the stock. On the petchem segment, the margins are expected to improve quarter on quarter, but they're still subdued compared to what we've seen historically for Reliance. Any thoughts here? And what would your view be on the stock? The stock has also underperformed. It's down 7% in this year so far. What do you see as the way forward?
So as far as petrochemical is concerned, you're absolutely right that compared to integrated margins of, let's say, a fairly long period of time when we saw $650 a ton as a fairly, steady level for integrated margins. The margins are still $500. I think globally demand metrics continue to be probably muted, and until we can see some more signals from Europe in terms of how their economy and their chemical demand actually picks up, I think that will continue probably to be a drag on the earnings. And I think that is what is sort of reflecting in this quarter earnings as well. There has been a marginal recovery on a QOQ basis, but broadly, nothing to be as far as petrochemical business is concerned. If I look at the stock behavior, we have had an ad rating on the stock for some time. While we agree with the contention that earnings growth will remain very robust and, they will probably continue to remain peer leading, particularly in the market cap, segment. The problem has been that the monetization of the capex that they're doing across businesses, whether it's Jio, whether it's the new businesses, the new energy businesses, that is still taking a little bit of time. And in the meantime, therefore, the FCF conversion and the return ratios continue to probably remain muted, maybe a bit more than what we had probably earlier looked at when their earlier capex cycle got over somewhere around FY 19 to 20, which is why while our fair value is about 15% higher than now at about $27 to $2,800, we're not sort of putting an absolute buy on the story as of now.
Okay, so 27 to 2800 is your fair value on Reliance right now, but you don't have an absolute buy. Is it also because, the other verticals are seeing a bit of a slowdown? You mentioned Reliance Jio, which is, of course, growth has slowed down because of the absence of tariff hikes. In the retail vertical as well, the EBITDA is expected to increase, just 5% sequentially. There's a lot of competition here. There is a lot of store additions that they're doing right now. So, of course, expenses are rising. Do you think these are also a couple of reasons why, despite having this 2700 target price, you don't see too much of an upside in the near term?
My apologies, I couldn't quite get the complete question with respect to
no, there's a bit of a slowdown in the consumption piece, right? Both on Jio as well as on retail. There's a single-digit growth expected in the EBITDA for retail sequentially. So, do you think that could limit the upside?
Yeah. No, I think in retail you have to sort of give credit to the fact that the scale at which they are operating, it's pretty much unlike what any other player in the country is like. So the fact that they are able to eke out even a single-digit growth on this pace in the environment that we are in, I think is pretty phenomenal. And I think that gestation period of the kind of warehousing and the retail space that they have put up in the last couple of years, I think that is something that is not something that would worry us. For Jio, yes, as I said, our telecom team led by Sanjesh believes that the monetization of the network capex and the kind of aggressive rollout of the 5G infrastructure is something that should dampen the returns and increase the leverage in the near to medium term. And I think that is what remains a little bit of a worry as and when the tariffs start to reflect this additional investment that has been done over the last 2 years. Maybe that will be a trigger for outperformance to start coming back, but till then, in the near term, that is something that makes us a little bit cautious.
All right, Prabal, we leave it there, and we would love to have you back on after we have the Reliance numbers for your perspective. Thanks very much for joining us. I think